Hello there, my friends. Chris Mark is here with you for another episode of Inside the Markets, and excited to have one of my favorite financial analysts, someone I've been following for years, who, Michael, I won't make you say it. I'll say it for you. You wrote years and have spoken in advance about the things that are happening now. So it's great to have you on, especially at this particular time when the stock market is getting rocky and appears as if we may be getting closer to the Fed reversing course. So great to have you on the show, and how are you doing today, my friend?
Doing great, and thanks for having me on your program, and great luck with, the best of luck with your new venture. I'm sure it'll be a wild success.
Well, I sure appreciate that. And to get started, what are you seeing happening next week with the Fed? I know you wrote an article recently where, different than some of the take out there of that it's definitely time to start printing again, where do you see that playing out?
Well, okay, so on October 3rd, Jerome Powell, the current Fed head, said that we were very far away from neutral. And most importantly, that the Fed funds rate would have to go above neutral for some time. So neutral being 2.5 to 3.5, so figure around 3. So Wall Street, right on cue on October 3rd, started pooping the bed when they figured out that Jerome Powell was going to gun up the Fed funds rate to 3.5 and leave it there for some time. And he's raising rates into a weakening U.S. economy and a crumbling international economy. You look around the world, things are not that great, Chris. You got Germany, GDP is falling, Japan GDP is falling, chaos all over Asian markets and in South America, Canada, Mexican stock market. So the global economy is shrinking fast, and primarily, and it's not because of Trump's trade war, primarily because China increased their debt $38 trillion off of $2 trillion in the year 2000. So it was that warp drive increase in debt that has completely rendered that communist nation completely unstable, which is now causing a lot of this chaos in growth overseas. But so Jerome Powell says on October 3rd, we're going to raise interest rates 3.5% on the Fed funds rate. And then the stock market fell down by 10%, not for the year, but 10% from its high. So Donald Trump has a conniption. He wants to fire Jerome Powell. He hates everything about Jerome Powell, even his hair. He doesn't like anything about this guy, even though he just hired him recently. Yeah. And then, of course, Jerome Powell acquiesces to the market in a small way. But here's what he said. He said that the Fed funds rate is just below the range of neutral. Wall Street comprised of a bunch of very compromised carnival barkers who all have agendas. They wanted to hear that the Fed funds rate wasn't going to go up any longer, that the Fed was now at neutral and we could sail off into some nirvana in the stock market. But that's not what he said. He said that the Fed funds rate was just below the range. Did you hear that word? Range of neutral. Now, the range has a beginning, a middle, and an end. It's like a nice story. Okay? The low end of the range is 2.5. So they're just below the low end of the range. It doesn't mean he's not going to raise interest rates in December. I think he for sure will. That's my best guess. Of course, I'm trying to read the minds of these central planners, but that's always a dangerous thing to do, but we have to do that to manage money effectively. Perhaps he'll raise rates one more time in 2019. But I got to tell you, what people aren't talking about is the fact that the Fed's balance sheet is draining by $50 billion per month. That's $600 billion a year. That, in my mind, is the equivalent of at least 4 rate hikes. So you have to add 4 to the 4 that they're doing in 2018, and then you wonder, well, why is the market falling apart? The market's falling apart because QE has ended on a net global basis. So the ECB just got out of QE this month. It's over. Okay, they're no longer they're gonna roll over their balance sheet, but they're not gonna add to QE. And of course, the Fed is, as I said, draining $50 billion a month. So on a net global basis, QE has gone from $180 billion per month to zero. And that's why the liquidity is coming out of the market. And that's why the market's falling apart. And you do not, let me just answer your question completely, like I like to do. Right. We don't have a Fed put yet. A Fed put is when the global economy might, or at least the U.S. economy stinks. That's true, but at least the Fed is lowering interest rates and printing money. So asset prices will go higher. And they're going to keep doing that until the U.S. economy and maybe even the global economy improves. That's called a Fed put. We have the opposite of a Fed put right now, 180-degree opposite. The Federal Reserve is going to keep raising rates until the economy falls apart. So you're either going to have an economic collapse and a stock market collapse, or the Fed's going to keep hiking interest rates to compete with, the riskiest part of the market. So that's what you're seeing here. It's a completely different dynamic from a Fed put. A Fed put is coming in 2019. It just hasn't arrived quite yet.
Yeah, and Michael, I appreciate you pointing that out. That's something I've been seeing for a while, that really the Fed is backed into a corner where there is no easy way out. They can talk about raising interest rates, but like you pointed out, we're seeing the effect that's having, or the alternative is just eventually blow out the dollar. Curious, though, your thoughts on the Fed's definition of normal rates or normal balance sheet. I mean, I can understand if they're below their range, although Volcker in 1980 raised interest rates to 20%. Even Greenspan back in 2006. In fact, I remember I first heard this from you years ago, how following that year of 1% interest rates, he raised, I believe his last hike was to 5.25%.
Yep,
So
2006. June of 2006, I believe.
Yeah, so I wonder where Powell gets this normal rate of around 2.5% or 3%. And just last point to add on there, I don't know if many people have heard this, but in one of his Senate appearances last year, Jeb Hensarling asked him about the quantitative easing balance sheet. He said the new normal on that was 2.5 to 3 trillion over the next 3 to 4 years. So they're not even talking about taking that away. What are your thoughts on his version of?
Okay, so let's. Since I'm 55 years old, I don't remember 15 questions.
Okay.
So let's go. I'll just try to remember all of what you said. So first of all, the balance sheet is on autopilot, Chris. So it's 50 billion, 600 billion in fiscal 2019. Okay, but the balance sheet was 4.5 trillion. Now it's down to 4.1 trillion. I'm hearing that a normalized Fed balance sheet would be somewhere around $2.5 trillion. It was 800 billion prior to the Great Recession. So 2.5, 3 trillion is still a big balance sheet, but the Fed has to withdraw 2 years worth of this reverse QE or QT. So we have 2 years of this. You're only going to have 1 year done in October of 2019. So we have 2 years of $1.2 trillion withdrawal of the balance sheet. And then I think the Fed will stop. That's their plan. I think they have to stop much sooner than that, Chris. But let's talk about this BS about, R star or neutral. I find it very insulting that these people that are in charge of the most important market indicator, free market indicator in the world, is the cost of money. But these people who have no clue what they're doing have the arrogance to believe, the hubris to believe that they know what neutral is. So, neutral, to me, a neutral Fed funds rate is we have savings in the banking system and we have demand for money. So when there's a lot of savings, right, and not a lot of demand for money, what do you think would happen with interest rates in that scenario? We have a lot of savings, no demand. Wouldn't interest rates go down, right? Right? And when we have no savings in the banking system and a lot of demand, then interest rates will go up. That's neutral. The neutral rate of interest should be variable, dependent upon the free market. But here we have relegated it to academics. They're not stupid, but they're arrogant and incompetent and feckless people. And I can prove it. Janet Yellen said a year and a half ago, Janet Yellen said that there will not be another financial crisis in our lifetimes, not her lifetime. Not that she's 95 on death's door, but in our lifetimes, which means probably around 50 years. She can't foresee it happening. Then, 16 months later, the world's falling apart. And she takes no blame for it. It's supposedly because of deregulation. So these people that we've entrusted with this neutral rate of interest are really completely feckless individuals. But what I think they're getting neutral at 3%. So they take the nominal Fed funds rate minus inflation. So this is the real Fed funds rate.
Right.
So 3% minus 2 is 1%. So 1% real Fed funds rate. That's where they want to be. That's their neutral R star. And they have all these stupid words for what they, don't really know what the hell they're doing. But I believe that Powell and company would love to get to around 3%. Okay. I don't think they get there, but that's what they would like to be.
Yeah, it certainly seems the more they raise interest rates, the more these bubbles are likely to pop sooner. And you mentioned China and some of the bubbles they have there. And along those lines, in one of your other interviews I was listening to, you mentioned Japan and their negative interest rate. And it's stunning, doesn't get as much coverage here, but curious with the money printing campaign that's gone over there, how you see Japan playing into all of this.
Well, Japan's one of the largest nations on the planet, GDP wise. I think they're number 4, but I'm not sure. They're top 5 for sure. My issue with Japan is not only the fact that they have a 250% debt to GDP ratio, quadrillion yen in debt, a 2% inflation target, but the big problem with Japan is they have a 2% inflation target and their 10-year note is almost 0. That doesn't compute. In the real world of economics, that's a complete disconnect and anathema. So what the problem with Japan is they're already in half of a recession and they have no way of extricating the economy from it. I mean, they're already at 0% on their 10-year note. Their discount rate is 0 and below. It's actually negative in their discount rate. And they're still in the middle of their QE program. Mm-hmm. So when Japan has a recession, what is Mr. Kuroda and Mr. Abe and the Bank of Japan going to do about it? I don't think they could do a damn thing about it. There's nothing they can do about it. So that's why I think this next recession could be protracted and exacerbated because central banks really all over the world, including China, the ECB is at 0. They haven't even begun to drain their balance sheet, but hopefully they do so in 2019. And the Fed funds, yes, we're the best. I like to say we're the single-celled organism with the highest IQ. We're the amoeba with the highest IQ. Yeah. That's what we are. So we do have, we are draining our balance sheet. And here's the issue. We also are raising interest rates. But here's the issue. I want to make sure I want to get this point across to your audience. So the problem is that, we had to engender the housing bubble, interest rates were 1% from 2003 to 2004. Mm-hmm. And then, Bernanke took them to 5.25% by 2006, somewhere 2006. But that 1% for 1 year blew up the entire housing bubble and created a financial meltdown that was global in nature. But now the monkeys that run our country and the global economy took interest rates to 0% and below and left them there for a decade, which not only re-engendered the asset bubbles, but also allowed the economy, global economy, to take on a tremendous amount of new debt. So you have a record amount of debt, $250 trillion in debt, up 70-some trillion dollars since 2008. And the economy existed okay, because you blew up, reignited the asset bubbles, and it was all predicated on one thing: zero cost of money and massive, unprecedented, never-ending monetary fuel in the form of QE. That is gone now. Central banks are believing that, hey, listen, we solved the global economy's issues. There's no more dislocations or abnormalities in the world. Everything's fine and dandy. So let's try to normalize our policy. And then what you're seeing now is the entire thing imploding, because when you have that much debt and asset bubbles that are completely disconnected from underlying economic growth, which, by the way, is ersatz and ephemeral in and of itself, because it's based on borrowing. I mean, what is borrowing? But it's taking consumption. It's borrowing, pulling forward away consumption and borrowing from the future. Okay. So savings is deferred consumption. Borrowing is pulling consumption forward from the future. So that's all we've been doing. And now it's time to live in reality, and reality is going to suck for the global economy. That's exactly what is occurring right now.
Yeah, it's stunning to imagine how this will all unfold. I'm curious, do you have any thoughts in terms of, with so much of this around the world, does this blow out some of the central banks and finally cause them to lose their credibility when we see this has failed yet again?
Well, Chris, as I said, the United States is the best of the bunch right now. And that's why, I manage money for a living. I've been long the dollar, even though I think eventually the dollar is going to lose its status as the world's reserve currency. I have a model that times when you should be long the dollar. You shouldn't always be short the dollar. You shouldn't always be long gold. You could do better than that by having a robust, rigorously back-tested model like I have, which I created. And I actually was also short emerging markets for some time this year as well. I covered that short. Emerging markets have been bludgeoned to death. But I want to tell you that part of the reality, what we're seeing now, and we're going to see even more in 2019, is that the sovereign debt and fixed income rate, interest rate spectrum and dynamic is going to have to live on its own. And here's the issue. So like I said, the United States is the best out of the bunch. But let's just look at the United States. I'm not even going to mention and go into the dynamics of Japan and Europe or China. But the United States publicly traded debt increased by over $10 trillion in the last decade. So running around the economy right now is $16 trillion of publicly traded debt. I'm not talking about the intra-governmental debt. So that's the unfunded liability, Social Security, Medicare. And then that brings it to 22 trillion. But that's not floated into the public's hands. It's 16 trillion. It was 6. So you have an extra $10 trillion of debt that has to be absorbed by the public. And we have a bond bubble, which I wrote a book about, the coming bond market collapse. We have all of this extra debt in the United States that is trying to be supported by a central bank balance sheet that is only, as far as treasuries are concerned, $2.2 trillion. So you've increased the number of bonds that the Federal Reserve holds by 2.2, less than, because we had about 800 billion. So it went from 800 billion to 2.2 trillion dollars in treasuries that the central bank is holding and rolling over, although they're not rolling over all of them because they're selling some of them. But that amount of treasuries that they're rolling over is trying to support $10 trillion of publicly traded debt that has to be supported by the free market. So what I'm trying to say is the entire interest rate complex is now going to have to live on its own 2 feet. So here's what's going to happen. And it's one of these 2 things are going to happen. Either interest rates are going to soar from where they are because they're in bubble territory. The 10-year note is 2.8%. It should be closer to 7 and even higher because of the amount of debt that we have. We're 105% debt to GDP right now, national debt to GDP. So it should be closer to 7% or higher, but it's 2.8. Okay? So bond yields will soar and crater the stock market and the economy, or I didn't create this dynamic, but here's the math and the science behind it, or interest rates are going to tumble because the global economy is imploding so quickly that investors are shoved into sovereign debt as a precaution to park their money. One of those 2 things have to happen. What you cannot have happen is central banks stepping away from their finger on the scale of debt markets and have interest rates stay where they are. Because they're in a bubble and they're trying to be supported by all this increase in debt. Like I said, $250 trillion of global debt, 330% of GDP. It just can't happen. Yep. And that's what the market's starting to sniff at now.
And plus, if interest rates go up, and if they ever hit anywhere even near 7%, even anywhere short of that, again, you have that rising debt expense for the interest payments on all of the U.S. government debt.
See, now people, I was unfortunately listening to CNBC with the sound on again. I keep on making that stupid mistake. But People are, what's going on? What's going on? The economy's so strong. Retail sales are terrific. Listen, the banking stocks are cratering. Housing stocks are cratering. Lumber, copper, these commodities, or oil. Why are all these things cratering? Because they understand the dynamic I just talked about. Because they know that the global economy is in the process of imploding because we cannot sustain this level of debt at this interest rate. It's just, the math does not work. And like you just said, interest rates will either spike, intractably spike, cratering banks, cratering the global economy, cratering the housing market, credit card loans, CLOs, right? Mm-hmm. Okay, leverage loans, which are wrapped into these collateralized loan obligations, which are trillions of dollars of that. Junk bonds are going to crater. We have $9 trillion in corporate debt. 14% of S&P 500 companies are zombies, meaning that they have to issue new debt to pay just the interest on existing debt. And as interest rates spike, they're going to implode. They're going to close their doors. They have to lay off people. So it's all happening. And that's why the stock market, which is still, Chris, wildly overpriced, crazy. It's 135% of GDP. The average is around 50. But even if we go back to 100, let's just say the stock market, the value of the stock market, market cap of equities, was to retreat back to 100% of GDP. 100%, still way overvalued. That means the stock market would have to plunge by 25% just to become like scarily overvalued. So that's it. Just, please don't make the mistake, your audience. Don't make the mistake of saying, oh, the forward PE ratio is 15 times. Bunk. You have no damn idea what the forward PE ratio is going to be. You don't have an idea what earnings are going to be at the end of 2019. I could tell you that right now we're trading at a very rich multiple. And I can also tell you that if you're just going to look at an earnings per share metric, EPS metric, which you do that, you're doing yourself a big disservice because it's been incredibly and massively distorted by a record amount of debt and share buybacks. I look at market cap to GDP, like I just said. How about the price to sales? Things like that. Those metrics tell you that we've never, ever been this richly valued before. Oh, by the way, let me just say one more thing. Yeah. That 25% plunge assumes that GDP, the denominator, doesn't go down, and it's going to.
Yeah.
Sorry.
Yeah, that's the thing. It can look good now, but all right, take away the printed money and then see what happens. Like you point out, which it's unfortunate CNBC and Wall Street Journal don't cover this, which is why I'm really grateful for the information you share and that people have a place where if they're seeing what's happening and they want help with their portfolio with someone who actually is looking and seeing what's going on, that you're there. So perhaps just in wrapping up, you can let folks know how they can find you.
So I run an actively managed portfolio. It's like a hedge fund, but it's an RIA. So, you actually can mark to market my performance every day. I clear through Charles Schwab. Mm-hmm. I have an inflation, deflation, and economic cycle model predicted back in April. I said the top 8 reasons to head for the narrow exit by October, by the fall. All 8 of those reasons came true. And there's even more reasons to get the hell out of the way in 2019. That's the way it looks to me right now, but I have that actively managed strategy. And, it actually is a great hedge for investors who have been inculcated to believe that you should always just buy and hold the stock market. That might have been true in 1960. Maybe during some time, but not in this era where we see central banks have become, they're not tinkering around the edges of the market any longer. They have become the market. And that's why you need to know, here's the genesis of my idea. Debt will be defaulted upon either through inflation or deflation at different times. And if you can model where we are in that dynamic, inflation, deflation, and growth, then you'll probably end up with a much better chance of making money, preserving your principal, and making money, hopefully, God willing, in all scenarios. That's what I strive to do for my clients. That's my only agenda, by the way. Only agenda. The only one.
Yeah, and I appreciate you pointing that out because while there are things that aren't ideal, doesn't mean everyone has to get clobbered. And that's why I'm happy to recommend to anyone who's listening to give Michael a call at pentoport.com for Pento Portfolio Strategies. You're in good hands over there. And Michael, you're doing a great service, helping people see what's coming, helping them prepare their investments. So thanks again for joining me today. It's a pleasure to finally catch up with you, and best of luck going forward.
Thank you so much, Chris. It was my pleasure to be on your program.